Hi everyone, and welcome back to the channel. When it comes to investment planning, deciding how to allocate your assets might be the single most important decision you'll make. But with so many options, selecting the right investments can feel overwhelming. And how do you combine them into a well-diversified portfolio that balances growth, risk, and any preferences you may have, such as sustainability? In this investment series consisting of 4 videos, that's what we're going to try and answer. Taking an approach that's backed by some of the world's leading financial academics, we'll walk you through what you need to know to build a portfolio for your individual needs and objectives. Hi, I'm Jim Smith, Senior Financial Planner here at Pacific Wealth. We specialise in helping new migrants and returning Kiwis navigate the intricacies of cross-border financial planning to help you make the most of your new life in New Zealand. In this, our 4th and final video of our investment series, we're going to be looking at how you can incorporate investment preferences such as sustainability and select the underlying investments. As an individual, you may have certain environmental, sustainable, or governance preferences. There are different ways you can choose to express these preferences in your day-to-day life, such as a consumer, in the things you buy, as a citizen, like the choices you make or perhaps who you vote for, and as an investor, based on what specific investments you select. If you have environmental, social, or governance preferences and wish to express these with your investments, you will need to decide how you wish to incorporate these. This is not quite as easy as it sounds, as when you get into the detail, there are a range of different issues and decisions you will need to make. For example, within environmental, as part of an ESG framework, you will need to decide how to incorporate issues such as climate change, air pollution, and waste management. And within the social dimension, issues such as gender and diversity, human rights and labour standards. And within governance, issues such as board composition, executive pay, and political contributions. Around 10 years ago, there wouldn't have been many choices for investors, but now most managers have their own ESG lineup of funds, and there is an almost bewildering array of choice for investors. To muddy the water still further, there's something called greenwashing, whereby a fund uses marketing spin to imply that it's a lot more sustainable than it is in practice. If you decide to express your ESG values with your investments, it can be difficult to get started. We've therefore outlined 3 common choices for investors and some of the advantages and disadvantages of each. An unscreened portfolio will invest without restrictions and therefore have the broadest exposure among individual companies, sectors and geographies. It relies on third parties to undertake any social or sustainability actions for you. For example, if you invest with an index fund, the manager, who holds a vast number of shares on behalf of investors, may still proactively engage with companies regarding various issues such as corporate governance standards and voting on executive pay, but it has no requirement to do so other than abiding by the laws of the countries in which it operates. Governments around the world are also enacting legislation, and because of this and market pricing, the value of companies is already being affected. For example, financial analysts may penalise the value of a company based on a future expected carbon tax or the possibility that it will have stranded assets. Whilst market pricing may incentivise companies to act in certain ways, they're only required to act in accordance with the laws of the countries in which they operate. This is a common choice by many ESG investors and involves both positive and negative screening. A negative screen aims to remove companies from their available universe where metrics such as the proportion of their revenue from certain activities reaches a certain threshold, such as 5, 10 or 20% of revenue. Whereas a positive screen will positively allocate capital to certain companies that have certain favourable ESG attributes. A light green approach may have a slightly narrower range of companies relative to an unscreened portfolio, perhaps 10% or so fewer. But overall you still end up with a broadly diversified investment strategy. Because of this, whilst there could be a financial trade-off, it is unlikely to be material relative to the standard unscreened portfolio over the longer term. Another advantage of this approach is that there are many low-cost and well-diversified options available. The downside though is that this lighter green approach may not go far enough or reflect any specific ESG considerations that you may have. A dark green approach moves further along the ESG continuum, removing more companies from the available universe and positively allocating capital to a smaller group of companies. This approach could have a greater environmental, social or governance impact, but at the same time there are more likely to be some financial trade-offs by allocating to a much narrower subset of companies. There are still a number of choices in this space, but they tend to be more nuanced. If this approach sounds like you, then you should undertake your own research or consider working with a financial advisor that specialises in this area. Active investing is a style that involves actively making decisions to buy or sell assets with the goal of outperforming a benchmark or the overall market. In this approach, investment managers or individual investors make frequent tactical decisions based upon their analysis of market trends, company indicators, company fundamentals and other factors. Passive or index investing, by contrast, is an investment style that involves constructing a portfolio that closely mimics a recognized index. The aim is not to outperform or underperform, but produce a return that's very close to the index. Active investing always sounds more alluring, because why settle for the average when you could produce alpha and beat the competition? But if you take an evidence-based approach, active investing ends up being a less reliable way to invest. It involves a degree of speculation or forecasting rather than holding the global portfolio that were described in the previous video. If you look at the results from the S&P Index versus Active reports referred to as SPIVA reports, these show that the odds of an active manager beating an index once their higher fees are taken into account is somewhere around 20%. Meaning that 80% of the time the returns will be below the index. The funds that do happen to beat their index are also not the same funds every year, so just selecting from the winning 20% of funds that beat their benchmark last year turns out to be a poor method. Instead, you can invest in a small number of low-cost index funds that will give you a diversified exposure to the universe of global listed companies. The other reason why an index approach should be preferred over active is that as humans, our physiology acts against us, and in many situations we are predisposed to making bad investment decisions. As an alternative approach to pure index investing, there are strategies that have similar characteristics but tilt towards certain factors such as value small and profitable companies, sometimes referred to as smart beta, which research indicates may provide higher returns than a pure market capitalization weighted approach. A multi-factor approach is likely to cost slightly more than investing in an index fund, but still considerably less than an actively managed fund. The backtesting of multi-factor strategies can look impressive, but a degree of caution is needed, as a multi-factor strategy could underperform the overall market several years in a row. However, if you are not happy just accepting a market rate of return and want to try and outperform, using a form of smart beta could be a more reliable way to try and do it rather than going down the active management route. But due to the complexities involved in picking and combining factors, if this is a route you want to go down, you may wish to work with a financial advisor. If you recall back to the third video, the steps in the process to determine your asset allocation were deciding on the overall level of risk and the amount you should hold in growth and defensive assets. Within growth, determine the level of home country bias and then allocate the balance to the global portfolio. And in defensive, limit the total amount of term and credit risk to ensure your fixed interest holdings can provide the defensive-like qualities. In this video, we explain how to incorporate investment preferences such as sustainability, as well as investment styles such as active, index or multi-factor. Once you've worked through these additional steps and made your choices, you now need to select the underlying investments. Whilst the range of funds is forever changing, when selecting your investments, you should focus on the following characteristics. You want to make sure that whatever investments you select, the fees are as low as possible. You want to make sure the fund structures are tax efficient based upon your individual tax situation. For many asset classes, a fund structure referred to as a New Zealand Portfolio Entity or PI might be the best approach. But if you are a US citizen, you will most likely want to avoid PIs and focus instead on US listed exchange traded funds. You ideally want as wide diversification as possible to remove any unsystemic risk by holding many hundreds if not thousands of underlying securities. And finally, liquidity, which means that you have the ability to withdraw your capital at short notice if required. We have come to the end of our 4-video series on how to determine your investment allocation. In the first video, we outlined all the major investment markets you could put your money into and then narrowed down the list as we approached this from the perspective of an individual investor. In the second video, we introduced the concept of risk factors and risk premiums and how we can use this understanding to determine the types of investments and the risks we want exposure to in our portfolios. In the third video, we outlined the process for building a portfolio, including growth and defensive assets, and how to allocate your capital within each. And in this final video, we have looked at how to incorporate your investment preferences and a process for selecting the underlying investments. All up, that's quite a lot of information to get through, which we hope you found helpful. If you are interested to learn more about financial and retirement planning issues that international migrants need to know when moving to New Zealand, we've also created other videos that you can explore on our YouTube channel. You can also visit our website www.pacificwealth.co.nz, and if you have any questions, please feel free to reach out to myself or a member of the team. Thank you for watching.